Hello everyone, my name is Arina Surdu and this is a brief overview of some of the research that I have been doing together with my colleague Edith on strategic trade-offs and the role of experience on foreign divestment and re-entry decisions. To start with, I would assume that everyone recognizes this character. This is Captain Spock aboard the Starship Enterprise, and he is known throughout the years to be rational and generally making decisions without emotion, right? So one of the things we thought about when designing the theoretical assumptions of the research was to understand whether we can think of managers or their organizations as being rational and making decisions without emotion, or whether we can think about the different biases or strategic reference points that decision makers make in order to decide when to exit a market or when to re-enter a foreign market and how to do so and the level of commitment in that market upon re-entry. So the focus of our research essentially has been around the drawbacks as well as advantages associated with going back into previously exited markets. And the rationale behind it is that is a source of management risk. But of course, if this is a source of management risk, how are these re-entry risks managed? And I have to say from the get-go that when we refer to foreign market exit and re-entry, we refer specifically to market-seeking firms that have entered the market, spent some time there, and then decided to exit, withdrawing their products or services from the market and chose to re-enter that previously exited market after a period of time out. But of course, in light of everything that is going on at the moment with the Brexit, with the NAFTA redesign, with the COVID pandemic, we will expect to see exits and re-entries of other kinds, such as divestment, that MNEs manage risk by engaging in a series of trade-offs. And of course, these trade-offs will be related to external but also internal sources of risk associated with foreign re-entry choices. Now, in this case, we propose that for re-entrants, exit may actually become the strategic reference point for evaluating future strategic choices, beyond aspects such as the firm's ownership or firm-specific advantages that it may leverage upon re-entry, because the exit experience is likely to be the most memorable. And we use in this case a sample of 654 MNE re-entrants. They're all large firms, and we focus specifically on foreign direct investment. So we have left out, for the purpose of this research, exporters, franchise licensing arrangements, and so on. Now, as a background, from a practical perspective, according to UNCTAD and World Bank, the last few years have registered record divestments, both domestic and international divestments, which shows that they have been an integral part of the way of doing business and the way of growing and redesigning international activities, mostly because of the complexities associating with managing all these markets. Now, in some cases, MNEs are expected to take what we refer to as a wait-and-see approach in the face of these risks. But of course, our data reflects the fact that a lot of firms do re-enter international markets in order to grow and continue diversifying their portfolios. So what are the risks of re-entry once you've exited? Now, the position we take in this paper is that re-entering a market leads to firms incurring a series of interdependent and interrelated risks. And the management of these risks will involve a series of trade-offs. And of course, this is because certain choices like exit and re-entry are highly complex and they will be dependent on the firm's strategic reference points. So in other words, do you have a benchmark that is oriented towards the future, potential growth and opportunities in the market, or do you have a benchmark that is oriented towards the past and not repeating past mistakes? How we theorize risk? Well, first of all, we look specifically at risk trade-offs. And the assumption with that is that decision makers are only boundedly rational because they will evaluate alternative choices in a less systematic manner than previously assumed. And that leads to the formation of certain reference points that in many instances are time-bound. And we know this from the vast literature on the role of experiential knowledge acquired in the past. Now, of course, when managers make decisions at a point that is lower than their point of reference, they are likely to be more risk assertive. When they make decisions at a point that is to a great extent, this relates to the manner in which risk is perceived by decision makers, and of course, for the purpose of our research, the manner in which the exit experience is interpreted by these decision makers. So with re-entry, fundamentally, we propose that the events associated with the pre-exit experience, so the reason for failure, whether it was externally driven or internally driven, whether it was a matter of being pushed out of the market or a matter of poor performance, they will remain embedded in memory. And they're very likely to have an effect when the firm decides to re-enter the previously exited market. So the process of re-entry looks something like this. So if we start at point T1 with the novo entry, and a lot of research has, of course, been done in international business on the international growth of the firm, we assume and we know that in many instances, in order to enter, firms possess some firm-specific advantages that they can exploit internationally. So at this point, T1, the risk is associated with the liability of foreigners, so lack of knowledge and experience with the market. The risk is driven by market prospects. So I will enter that market because of the prospects that I can achieve, but also because I can exploit my current resource and capabilities. At T2, we already have the firm that has acquired some level of market-specific experience. And of course, risk propensity at this point is expected to be reduced because the liability of foreigners has been reduced. At T3, we record the market exit. Now, exit for a firm may mean a loss of assets, customers, business relationships, particularly when we look at direct investment, where a certain degree of commitment to the market had been made at the point of entry. So the negative experience here is likely to become a memorable one. And it has a high emotional impact on the firm and decision makers who may be associated with the failure. Of course, we have instances where one could argue that firms exit strategically, but actually those represent a very small percentage of our sample. In most instances, poor performance is a key motivator to exit a market. And of course, between exit and re-entry, you have this timeout period, where the interpretation of the prior experience takes place. The knowledge acquired may be interpreted, some of it is embedded within decision makers, others embedded within the firm, and of course, the risk trade-offs associated with when and how to re-enter become evaluated. Now at T4, we have the re-entry. Now here we propose that compared to T1, where managers are more likely to be oriented toward the future and the gains they can achieve from the market, at T4, the most important factor that may be considered is the exit experience, looking towards the past and the lessons that can be learned from the initial market foray. So in this case, we expect trade-offs to be managed through strategic flexibility, as there is likely to be less confidence in the ability of the firm to use and exploit its resources and capabilities because it has not worked the first time around. Now, experience in this case can generate strategic flexibility, particularly when experience is market specific. This has been something that has been studied in the literature for a long period of time. In most instances, MNEs may influence their overall level of risk by using modes of re-entry that provide them with greater flexibility. So you have two ways in which you can achieve flexibility. One is the ability to use some of this experience acquired initially, and second is using modes of re-entry that can generate flexibility. And we know that the mode of re-entry is one of the most important decisions for the firm associated with international growth. So we have a series of hypotheses. And essentially what we look for here is to understand how firms may balance the different risks and drawbacks and advantages associated with these choices. So for instance, if we consider the risk associated with the host market, the already international diversification of the firm, the time it takes to re-enter the market, so the timeout period, the speed of re-entry, one could argue, and the re-entry mode, we assume that these will be traded off against one another. And we also look for the moderating role of experience in all of this. So will a highly experienced firms be less likely to look for flexibility through a joint venture than a less experienced firm, or the other way around? So we assume, for instance, that for a re-entry, higher host country risk will be traded off against choosing partner-based modes versus wholly owned subsidiary. International diversification will be traded off against choosing wholly owned versus partner-based modes. Speed of re-entry, again, will be traded off against choosing wholly owned subsidiaries versus partner-based modes. So our assumption is that firms will look to reduce some of the risk in certain areas associated with high commitment to the market, depending on other risks taken in terms of how diversified they are already or how quickly they seek to return to the market. And some initial findings look like this. So if we think about each of these equations as the choice of making the decision to enter, for instance, a high-risk market, a highly risky institutional market, a high-risk market in terms of market growth, the firm being highly internationally diversified, or entering a market very quickly. These are traded off against the risks associated with how do you do it? Do you choose for a wholly owned subsidiary, or do you choose for a partner-based mode? There are trade-offs associated with these decisions. So for instance, there is a negative relationship between market risk and the choice of a wholly owned subsidiary, particularly for highly experienced firms. But also for low experienced firms, if we look at this here, although the effect and the impact is slightly more reduced. In the same way, if we look at market speed, there's a negative relationship between going into the market very quickly and going through a wholly owned subsidiary. But this is mostly the case for highly experienced firms and less experienced firms. So one of the things that we noticed in our research is that it's not necessarily the case that experience provides that level of strategic flexibility. In fact, in some instances, experience may lead to firms becoming more inert, and the more time you've spent into a market, the more likely you are to have invested knowledge there, you have invested time there. So there's a reluctance to commit significantly to the market the second time around. So broadly, we did identify some of the risk trade-offs that re-entrants make, such as trading off risk associated with the market against risk associated with institutions themselves. Re-entrants with high level of international diversification re-enter into countries with higher risk, but they take longer to re-enter. And again, this might be one of the reasons associated with the fact that they already have their resources spread across multiple geographic markets. In this case, they may not be able to re-enter the market and commit significantly unless they take a certain period of time out of the market. International diversification of the firm also reduces perceived international risk, so firms operating in many markets may not avoid re-entering into high-risk countries because of that rich knowledge and diversity associated with operating international markets, but at the same time, they will take longer to re-enter. And of course, when it comes to the balance between where you go, so location choice, and how you do it, we did find that MNEs sacrifice control of operations for strategic flexibility. So experience accumulated over time does not necessarily provide firms with strategic flexibility to completely limit re-entry risk exposure. And perhaps one of the reasons for the fact that we did not find market-specific experience as a carrier of flexibility or investor confidence is because it may be superseded by the exit experience that the firm has had. So in some instances, learning from firm-specific knowledge can be replaced with learning from local partners, and that is why we see these firms opting for other than wholly owned modes of operation. So some of our contributions, like I said before, a key contribution here and an interesting finding is that we did not find solid evidence that market-specific experience provides strategic flexibility, which reflects the fact that actually there are other types of experience, like the exit experience, that might supersede it. Highly experienced MNEs overall also experience greater trade-offs, because these experiences, particularly as these experiences were accumulated during the initial entry, may not have proved sufficient for them to learn and use upon re-entry. So we do suggest that it's important to understand in a more nuanced manner whether and when the possession of assets, such intangible assets such as experience, does impact risk perceptions, whether they can always be used as management tools, because we do rely a lot in our theorization on the role of the firm's experience in making certain choices related to risk. And we also, of course, need to understand that these decisions are dynamic and they are non-linear, and the points of reference, whether they're internal, external, or related to the past or the future, do change over time, and certain experiences or certain assets may become less useful to the firm as the firm progresses and expands and exits and re-entries through different markets. And of course, this is what makes these key strategic decisions. Thank you very much for listening.